Hello all, and welcome to the Preparing for a Recession webcast. We'll begin in just a few short moments, but before we do, I'd like to remind all attendees that they are currently in listen-only mode, but to please feel free to ask our expert panelists questions at any time, and we'll answer them during the live Q&A session at the end. With that, I'd like to hand it over to Mark Moses.
Welcome to the webcast. What every CEO needs to know about preparing for this upcoming recession. This webcast is brought to you by our team at CEO Coaching International, where we currently coach just under 500 companies around the globe. My name is Mark Moses, and greetings from the south of France. I'm grateful to be able to travel back here again. It's been some time, I think 3 years since I've had the opportunity to be in Europe. Today, we'll be discussing recession best practices, risk mitigation options, how to identify your leading indicators, letting you know that a problem is brewing, scenario planning, cash bridge analysis, liquidity testing, and potential business opportunities during a recession so you can play both defense and offense at the same time. All of our 60 coaches at CEO Coaching International have led businesses through recessions before, and many of us have done turnarounds in part due to recessions. Well, in part because we may have made other mistakes, but we do have experience dealing with these matters. We know how to deal with this and have the playbook. Even during COVID, 87% of our clients at CEO Coaching International told us they were better off 12 months into the pandemic than before by following the playbook. So why are we here? Inflation is at 40-year highs. According to the US Labor Department, the annual inflation rate for the United States was 8.6% in May, up from 8.3% in April. And retail sales were down 0.3% in May, which is another negative leading indicator. The stock market, as everybody knows, continues its downward trend as all major indices are dropping. Year to date, the Dow Jones is down over 17%, the S&P down 23%, the NASDAQ down 32%. And treasuries, the worst start to a year in history, yields continue to climb as the Fed raises rates. And this week, as you all know, a historic 3/4 point rate increase. And an increase of this size has not happened since 1994, 28 years ago. Yesterday as well, to tame inflation, European central banks, including the Bank of England, the Swiss National Bank, and the National Bank of Hungary, increased their interest rates as well. Hundreds of billions of dollars have been lost across social media stocks and tech companies. Crypto markets have lost $2 trillion in their collapse. The immediate trigger for crypto crash appears to be a massive sell-off by investors worried about inflation and moving away from riskier assets. SoftBank's Mammoth Vision Fund posted its worst annual loss as a result of the tech downturn. And due to the aftermath of the pandemic, the current war in Ukraine, scarcity of resources, mostly driven by the war, inflation, interest rate hikes to curb inflation, a wave of layoffs is sweeping across the US and around the globe. It is overwhelming to hear some of the companies that have had massive layoffs. I'll share some of these here. According to Insider and Intelligence, Peloton has laid off approximately 2,800 people. Real estate brokerage Compass has laid off 450 people, 10% of its workforce. Real estate brokerage Redfin laid off 470 people, also 10% of its workforce. Coinbase announced plan to reduce its workforce by 18%. Online car dealer Carvana by 2,500 people, or 12% of its workforce. Reef Technology, 750 people and 5% of their workforce. And GoPuff, 400 people. Better Mortgage laid off 4,000 people after losing $100 million last quarter and announced they'll be laying off another 3,000 people. IT services and IT consulting firm TomTom 500 people. The Denver-based customer service company StarTech plans to lay off 472 people. Weight loss app maker Noon laid off 495. Amazon aggregator Thrasio laid off 20%. The point I'm making here, this is across all industries. Robinhood, 300 people. One of the largest publicly traded cannabis companies in Canada, Canopy Growth, / 250 jobs. Cameo, who operates a service where users can pay celebrities to record personalized audio or video clips, laid off 87 people. PayPal, 83. Gorillas, a German grocery delivery company, 300 people. Netflix, 150, and this is its second round of layoffs. Latch, a company that makes a smart lock, laid off about 130 people last week, 28% of the company's total staff. Tesla has announced a hiring freeze and a planned 10% layoff. Getter, a Turkish delivery startup, announced a layoff of just under 4,500 people, and Swedish payments giant Klarna has laid off about 700 employees, or 10% of its workforce. Around 75% of Bengaluru-based health tech business Mfine's personnel have been let go. And Chinese e-commerce giant Alibaba Group's holdings joint venture in Russia, AliExpress, has laid off about 40% of its employees since the start of the war. Vroom, an on-demand car buying and selling startup that has raised over $300 million in venture funding, has laid off more than 2,700 people. Ford Motors, 580. Condé Nast, 90% of its employees will be laid off. Nectar Therapeutics shed nearly 200,000 square feet of its office and laboratory space and 500 jobs following failing clinical trials. Tunis Air, 1,000 people. Chinese ride-hailing company Didi, 20% of its workforce, or 3,000 people. Humanity Therapeutics, a Boston-based clinical stage biopharmaceutical companies. And I know some people wrote in and asked if will my pharmaceutical or drug company be affected. Well, here they've laid off 60% of its workforce. Taxi company Vinasun has laid off more than 2,500. Even Unilever, 1,500 management roles. British Royal Mail set to lay off 700 people in management jobs as part of their cost-cutting plan. French car company Renault, 1,700 employees. Spain's largest telco, Telefonica, 2,700. Zillow, Seattle-based, to close down its house flipping division and lay off a quarter of its staff, or 2,300 people. Uber and Meta, also known as Facebook, have announced a hiring freeze, and the list goes on. I could go on for hours on how many more of these that you may or may not have heard of. The big point is, this thing is real and it's global, and a recession is coming. Regardless if you think you're immune, and some companies may be immune, you need to prepare. There are still issues in supply chain around the globe as a result of the pandemic and the war in Ukraine. Credit card and auto loan defaults are climbing. Remember what happened the last recession, where for your credit lines in your company would just get cut, frozen, and your credit cards, whether you were in good health or not, or a high FICO score, were getting cut as well. Homes are staying on the market longer. Startup investors, including Sequoia Capital, are warning their companies to hunker down as they're seeing signs of a prolonged recession. Experts are writing that the macroeconomic environment is deteriorated further and faster than anticipated. JP Morgan Chase's Jamie Dimon says to prepare for a hurricane. An economist can tell you why a recession is happening, but they can't tell you what you should do to overcome and conquer it. Recessions happen approximately once per decade. So many of us have been through this before, and it's been a while since we had one. On today's webcast, our panel of coaches will share items that you should have on your checklist for preparing and leading your company through a recession, and how to take advantage of opportunities that recessions creates for your company, how do you leverage that? And I especially want to dig into the following: determining your top risks, ranking them in order, and having a plan to mitigate each one of them. With each risk, what are the leading indicators warning you of a problem? Is it gross margin pressure or gross margin erosion? Accounts receivable increasing? Maybe it's bad debts increasing. Is it a longer sales cycle? Vendor delays or challenges? Will they meet your demand? What if vendors raise their prices? How will you deal with that? Supply chain issues. Borrowing costs are going up. What's the impact on your cash flow? Banks or suppliers tightening their credit terms. Don't get caught flat-footed. The warning signs are here, and this is on you as the CEO. And given where the discussion goes today, we'll also attempt to visit the following: scenario planning based on a variety of metrics in your business and the impact on profit, cash flow, inventory, using a sensitivity analysis or cash bridge analysis. Top grading top talent, now's the time. Companies get bloated in the good times, looking at unproductive expenses. What opportunities exist? Competitors struggling, maybe due to reacting too slowly. There's going to be opportunities in the market for you if you're available to take advantage of them. Maybe some M&A opportunities. So at this time, let me introduce today's panel. Jaime is a global business leader with extensive experience turning around failing divisions into growth engines. He's worked all over the world, including some of the toughest part of the world, including Venezuela. He's manager-led businesses from 20 million to 4.5 billion and up to 12,000 employees. He has served in roles as president, CEO, CMO, COO, and chairman at companies like Goodyear, Kodak, Levi's, SC Johnson, and Procter & Gamble. Kevin Adams has led public, private equity-backed, and family businesses, including Isogenics, ConAgra Brands, International Home Foods, Stella Foods, with specialization in food, nutritional supplements, skincare, direct-to-consumer, e-commerce, and traditional retail distribution channels. He's led or participated in over 20 private equity-backed acquisitions and integrations and raised capital for minority buyouts, opened international markets in Asia and Central America. Randy Dewey has over 30 years of global experience, including turnarounds at Blackstone. He's also worked in family offices and public markets. The organizations he's led range from startups to 750 million in revenue. Randy has raised hundreds of millions of dollars in debt and equity financing and participated in 15 M&A transactions. Ramona Capello has spent over 30 years in the food and beverage industry. And as an entrepreneur, a leader, and CEOs at companies like Celestial Seasonings, Kendall Jackson Winery, and Nestle, where she created the Coffee Mate liquid creamer, as well as being an entrepreneur in many of her own ventures. Jerry Pokel has led 7 companies as president or CEO, mostly in technology and software, from startup to leading the color printing and imaging division of Tektronix and a $2 billion division of Xerox. He has U.S. and international experience in distribution, manufacturing, product development, licensing, and M&A. Shep Moyle has spent his career as an entrepreneur, CEO, chairman, family business owner, building one of the largest specialty branded retailer of party supplies, decoration, and personalized items globally. He has deep experience as well in retail e-commerce, branding, digital marketing, acquisitions, on-demand manufacturing, and supply chain. Interestingly, he began his career at Frito-Lay, responsible for Doritos and then the Tostitos. I personally selected this panel of coaches based on their diverse and broad experience, so let's get started with our questions. Are you ready? Okay, here we go. So first question is, based on past recessions, what is the biggest thing you learned as a CEO? What mistakes did you make? What you would have done differently and why? Jaime, can we start with you? Jaime, you are muted.
Hello, can you hear me?
Yes, sir.
Super. Thank you very much, Mark. Welcome, everybody. As you know, I've been through like 80% a month inflation in Brazil, and Kodak, we're growing like 14% the category. In 3 months, we went to -5%, and then in another 6 months, we went to -30%. So a lot of ambiguity, a lot of change. And the two things, Mark, that I learned the most, one is on planning, and the other one is execution. On planning, I learned that when we don't know where the bottom is, instead of scenario planning and discussing what scenario is right, is give a totally different approach and go to a menu of choices of what we can do. So number one, add the dynamic of probability. So divide the choices we have, the business choices we have between decisions, which is 100% probability. If we let go 20% of the workforce, is 100% chance that you're gonna get that cost. Second, projects that either are tested, which have high probability, or non-tested, which have low probability. And third, try harder. So when you construct the list, instead of having a discussion which scenario is right, we have everything planned and everything prepared that we can access through a decision tree. And from an execution perspective, is double down on the levers that have the best probability of results. A clear example of that in P&G, when we were faced in a recession, we cut 30% of the marketing budget, but we increased 50% of the marketing budget in 2 areas of the country, which represented 65% of our consumption, and that increased our business in 50%. And Kodak, we did the same thing. We cut 30% of our workforce in sales, but we increased 50% the key account teams in the top 20 accounts, and we increased in 50% the spend in the 4 top buying seasons of the year, and that increased our business in 30%.
Jaime, thank you for your opening remarks. Shep?
Yeah, Mark, after watching, through recessions and watching YPO companies around the world for 3 decades, my lessons have been value speed over precision. Move quickly, establish your priorities, but don't value precision, value speed, because speed kills. Number 2, be bold, be very clear on what you're not going to do, and move quickly and be bold in your actions. Cut deeper and harder than you ever think that you might do, because everyone tells me I wish I had moved harder and I had moved faster. And then finally, engage the team. Most of our managers, most leaders today have not been through a recession in the past 10 years. We need to teach them what it means to manage in a high inflation environment, and what it means to reposition and repivot our business to give them confidence that we're going to get through this.
Shep, thank you for that. And it's really interesting. Somebody wrote in, how do I talk to my team about this issue? How much do I tell them? And it's a great topic, because how do you manage not scaring them, being honest with them about the real reality? Like Jim Collins says, got to recognize the brutal truths of your own reality. Jerry Perkel?
Yeah, I think back to your first question, Mark. The thing that I learned was to make sure you're looking for the indicators. What are the indicators that's starting to go south? Whether that's in, are people taking longer to pay? Are they negotiating price harder? Are they delaying orders? Or what's going on with the suppliers? And so that was the first one. Second one was stop trying to rationalize away that data. It's easy to say, well, that was just one customer who slowed down, or that was just one supplier. No, don't fight that urge. And unfortunately, if you have a high performance team, they're good at rationalizing too. So stop doing that. Face the brutal truth, as you said. And then I think the third thing was to make sure the communication channels are open. The people that know the most about what's going on are the ones on the front line. So if you have a large organization, make sure the data from your salespeople is getting up to the C-suite. The people that are dealing with the suppliers, get that to the C-suite. The people that are dealing with the people paying the bills, get that to the C-suite, so you can make sure you're making good decision on the best data that's available in real time.
Jerry, thank you. It's like you stabbed me when you said the rationalization of, you can talk yourself into everything, And then, like Shep said, you wish you moved a lot faster. Thank you, Randy.
Yeah, I agree with my colleagues for sure on those points. Two things that weren't mentioned, though, I think is really important, is that the recession will impact your customers and your suppliers differently than you. You can't just assume that, if you're in a sector that's doing pretty well through the recession and things look okay, doesn't mean your customers and doesn't mean your suppliers are okay either. They may have a weaker balance sheet. They may have extensions that you don't even realize. They may have different divisions that are doing better and they deploy capital in a different direction and all of a sudden starve the division that you're the upstream supplier for. So you've got to assume that if you're okay, it doesn't mean your customers, doesn't mean your stakeholders are doing well. So you got to be closer to them. If they're public, obviously you get great information, but keep close to your partners because your partners might not be as strong as you think. And the second thing is that the mentality that you have going into the recession is so important. Like, it's not just survival here, but how do we thrive in the middle of this chaos? So how do we then take advantage of the opportunities that are there, take those obstacles and convert them into opportunities? So just having a survival mentality means you're just kind of hunkered down, which we need a bit of that, obviously, but how do we take advantage of the opportunities in the midst of the issues and actually get ahead?
Great, thank you. Ramona?
Yeah, so some really great points. I think I just want to add a couple of things really quickly. One is, we hear cash is king. We know cash is king. I started a company in 2007. So when 2008 hit and I was trying to raise money, it meant something really different than just words. So we hear those words. We have to embrace those words because when you run out of cash, you may not get any more. So everything you can do to conserve cash so that you can arm it appropriately, take advantage of opportunities, cover problems that you may have, go long on something, short on some things. The other thing I want to put an exclamation point on is your own team. I like to think about three constituents through all this: vendors, customers, and employees. Your employees, we have to recognize they're afraid of what happens in their own homes, almost more than in our company. So we have to talk to them. We have to let them know we're not afraid. We have to help them plan. We have to give them confidence and inspire them and energize them to help the company and their families get through this. There is a pot of gold at the end of the rainbow if we search for it and plan for it.
Thank you, Ramona. Kevin?
Thanks, Mark. I think, I'll echo a little bit of what Jerry said in that, uncertainty, ambiguity, it causes a lot of people to be passive. And so the passive person doesn't survive in this, doesn't thrive in this. So one is to be more aggressive, to take action. The second is a lot of people focus internally. So they look at what's happening to them, what they can do with their organization, what costs they can cut. But I think the real lesson is you have to look at changing customer dynamics. What are customers doing? Where are they going? How do we get out in front of the customer? What implication does that have to our business? How do we leverage our asset to serve our customer and their changing buying patterns? So I think there's a lot of work that has to be done to really think about what implications a recession has on our customer. And if we can serve our customer, we're always going to succeed.
Great, thank you, Kevin. Jerry, you wanted to do a follow-on?
Yeah, a couple of quick things. One is somebody mentioned, how do we deal with this without creating negativity in the organization? Well, first of all, trust me, all your employees are reading all the same newspapers or watching all the same TV shows. They know things are going on. They have friends that got laid off. So if you're not doing something, then that's what's going to scare them more than anything else. Secondly is, what's the worst that can happen here? You prepare too much and it doesn't come about. Okay, so you've gone through and done some scenario, not a real big cost to you, but the cost of not preparing is huge. And there's never been a time when an ounce of prevention is worth a pound of cure here. So be prepared, look out further, do the work to be prepared based on what things could happen.
Great, thank you, Jerry. That made me feel calmer when you described it that way. Thank you. Jaimin.
No, just to follow on, I love the idea of crowdsourcing. to your point, our vendors, our suppliers, our employees. You know, a lot of things I mentioned, 70% of the ideas and the successes I had in my life, it was because somebody else in the organization had an idea, either inside the organization, or it was a vendor, or it was a supplier. If we open those channels and the sensors and we reward people for them to come, the people who are closest to the problem, who are closest to the customer, and market back and customer back, if they can have a channel to their ideas, this is phenomenal. So I love the subject.
Let me move to a different question. A lot of businesses still are healthy, and a lot of our clients at CEO coaching, or most of them, are really healthy and doing better than they have the prior year still. So it hasn't caught up to them yet. What is the one thing you would recommend they do now, even when they're still winning and they may feel this is not going to affect me? Don't all volunteer at once. Thank you, Randy, and then Jerry.
Absolutely, you have to consider that mentality and that approach in leadership is going to telegraph that same message, but you need your organization to be on their toes to anticipate that these things are going to affect us. So planning, creating that war room, getting that mentality that we have to prepare in order, and if it doesn't happen, great, you know, as Jerry said, you know, an ounce of prevention is worth a pound of cure. So we have to get ahead of it, and as leaders, we have to set that tone. So getting out ahead of it, getting that war room mentality created, and start getting those remedial actions prepared, those opportunities to pursue, that financial foundation analysis, make sure that you're well prepared.
Excellent, thank you. And I think what you said when you talk about war room, it's back to scenario planning, as others have described, going through this what if analysis on a variety of scenarios. Jerry Burkell?
Yeah, I think you hit it right in the nose there, Mark. It's doing the what ifs. What if revenue went down 10%? What if it went down 20%? What if my largest customer stopped ordering for 3 months? What if the guy that has huge backlog with me suddenly realized he doesn't need it anymore? One of the things I find with a lot of our clients right now is they've got really large backlogs. Because supply chain is a mess, they've got large backlogs. What does that mean? Well, people have been sometimes ordering what if. They've been ordering double just to make sure that they can get it because the supply chain is such a mess. Well, if their demand slows, not only will they stop ordering, they'll start canceling. And all of a sudden, a big backlog can shrink to nearly nothing in just a few months. So it's the what ifs. What if this happens? What does that happen? And just to follow up on one thing somebody else said, it's not the CEO's job to have all the best ideas right now. It's their job to get the best ideas on the table. And that's really important. And so I think that's the key thing that somebody said earlier, making sure you get crowdsource the ideas.
Hey, let me just piggyback on somebody said. Somebody wrote in a question about this. I'm super healthy right now. Should I load up on inventory and get an asset-based lender to support me on that inventory? It's an interesting question, right? Supply chain's a mess. Shep, I know you've been down this road. Supply chain's a mess. I want to load up yet, and I'm healthy right now. What do you recommend? Shep, you want to take that one?
I absolutely want to take this because I've lived it for the last 2 years. So my advice would be absolutely not to load up on inventory. This will be one of the key indicators to manage. What are your turns? What's the aging of your inventory? How do you deal with obsolete inventory? Think of your inventory today just as cash. And as Ramona mentioned, cash is king. The second part of this is the linkage to our banks, to our financial institutions, and to our investors. Fear is the leading indicator here. And with banks and with our investors, they are going to be fearful. They are going to be nervous. Our key is to make sure that those relationships are strong. We show that we have a plan. We plan for, in case our credit line gets cut, have we pulled sufficiently on that? Have we put ourselves in a liquid position that gives us opportunity to invest when we need to? When we put it into inventory, that's an asset that's going to sit there and we're just going to look at it. So try to put your assets in liquid position that you can deploy for the opportunities that will present themselves.
Great, thank you, Shep. Jaime, and then Kevin and Ramona.
Shep, I'll just extend on what you're saying. And the look of inventory is not only our inventory, is to extend the supply chain to understand what's our suppliers' inventory, what's their manufacturing capacity, you know, what's our downstream inventory, what's the inventory of our customers. So one of the things I did in the past is say, I'm co-responsible for inventories based on a joint sales forecast and production forecast. So when you extend the concept of inventory, not only for our inventory, of everybody's inventory, you optimize everybody's supply chain and you optimize everybody's cash.
Yeah, thank you, Jaime. Kevin?
Yeah, I think one of the concepts is in rising prices, do I lock into some lower cost inventory? And there's scenarios where that can make some sense, but you're limiting flexibility. And you have to look at it as what's the alternative use of that capital? Is it to you know, get market share? Is it to do an acquisition? Is it to do something else? And to have some flexibility. So I would think very hard about doing that for a short return, a small gain versus the flexibility to go after bigger items.
Great, thank you. Ramona?
Yeah, one of the things that often happens during this time is because fear is a leading indicator, we're afraid to talk to our vendors. We're afraid to talk to our customers. Over communication is better. The closer you are to them, the more they know where you are, the more they know what you can do for them, the better the relationship is. Because when they are in trouble, you will be the first one they call. You are likely to be at the front of the line to be able to purchase goods or to sell goods for them. And that's where you want to be. So over communicate.
Great, thank you, Ramona. I remember an example years ago in the last recession, one of our clients had not communicated well with their largest vendor who failed to deliver to them. And this client of ours failed to deliver to Costco just before Christmas and lost their biggest account, Costco. So if that communication really does matter. Jerry Perkel?
You want to take off on something Kevin said. Right now, flexibility and agility are the keys. And back to the question that Shep answered about the inventory, how much flexibility and agility do you give up by loading up on inventory? And you want to be flexible right now. You want to be able to move quickly in different directions. As Ramona said, talk to your key clients, talk to your key suppliers. It may be a great time to get some better terms from your suppliers. They may be really hungry to hold on to your business. It may be a better time to get better terms from your clients. You know, if you got a big client that needs guaranteed support and you're going to have to load up on inventory to support that, maybe you can get some non-cancelable orders or something else to be able to do that. But flexibility and agility are the key right now.
Thank you. There's a number of questions coming in. I'm trying to keep up with them all. One of them is, I want to tackle two topics now. One's a bit predictive. Randy, I'll move to you in just a moment. But before I do that, because I want you to show them that really cool liquidity tool. People are asking about marketing. And Jaime had brought, I think it was Jaime brought this up earlier. Do I cut my marketing budget now? That topic is one that, because for a lot of people, it's a really big line item, but it drives the growth of the business. What advice, if a few of you could chime in on that about marketing? Kevin?
Yeah, I think it's actually a great time to go against that trend and to actually stand out. So it's a great time to actually invest more in marketing. As your competitor is maybe weakening their position, it's a great time to get market share. It's a great time to double down in that area if you can. That's going to help you be more recession proof. That's going to help you connect to your customer. And now's the time you can get some really good gains. So offensive strategy, channel money into marketing.
Yeah, I like what you're saying, and maybe changing the messaging to make sure you're hitting the right audience and the right message. Ramona?
Yeah, just to build on that, it's not just general marketing though. You have to be really strategic and then tactical to support the businesses that make sense. think about the leading businesses that will bring other products or other services into the sale, and target your audience, whether that's geographically, demographically, psychographically, and think about the channels of communication. Some have better payout than others. Now's the time to really dissect what works, what doesn't work, and think about what will work when your customer or consumer is in a recession position, to figure out where you put the emphasis. All things are not equal.
Thank you, Shep.
To build on that great point, Ramona, just think about the changing the efficiency of your marketing mix. So it's not reducing your marketing spend, but reallocating those dollars to the most efficient spend. So perhaps it's looking at focusing on your existing buyers, on your current customers, and figuring out how do you increase their average order value? How do you increase their purchase frequency? Because their efficiency and the marketing dollars are going to go much further with your existing customers. So look at the mix of your marketing dollars, look at the profitability by customer, by channel, and by product, and determine how do I find the most efficient model. And as Kevin said, double down and invest as we get through this, because this situation is time oriented. We're not looking at a situation that's going to last for the next 10 years. This is a 15 to 18 month situation, and it's our chance to take advantage and to use market share. And I believe marketing efficiency is one way we can get there.
Great, thank you, Shep. I'm going to move different directions. I know Jerry, you want to chime in a little bit more. Randy, there have been some questions about the predictive analysis and some of the topics we can talk about before. Maybe you could show us analysis that you've used in the past in terms of your liquidity and how one can look at their own business.
Yeah, thank you, Mark. So, a couple things to really keep into consideration. One, bailouts and stimulus, probably all used up in COVID. So I think that train has probably stopped. We're coming off a decade of, cheap capital, and available capital was partially covering some of the, oversights and spending. So this is a really good time. I think it's going to call upon management to really look closely at their cost structure and find out where they're weak. So this model I've built over the years, used it many times, and it really just creates the opportunity to really challenge yourself and the management team about some of the things that we assume are going to continue, and puts light, I think, on the real key areas. So in the model, there's 7 numbers. It's very simple. You get these 7 numbers pretty quickly. You plug them into the model. You start with the revenue, of course, on a monthly basis. Do that on as an average over the year. Get some, helps with leveling out some seasonality, and then you start testing the revenue. Like, if mine, potentially, could I get hit with a 25% impact? What would that look like on my cost structure? As Shep said, 18 months is typically the cycle of time it takes for the banks to recover, or maybe your industry to recover, or for you to get yourself ahead of your industry and start actually gaining ground. So 18 months is really the typical period of time that you want to consider. Your gross profit is what your average has been. What is your OPEX, which is unfortunately a little elastic. You can't cut your costs as quickly as you can. Your people costs are going to live with you for severance periods and so on and so forth. So say that's static, at least for the foreseeable future, potentially that 18-month. And then it drives down into the, what is your interest expenses? You can't give up your bank debt. You got to pay your finance costs. What are your CapEx? You're not going to stop in the middle of a recession with the investments in the future. So assume those continue on. What would that look like? And then what is your actual cash on last month's balance sheet? And what's your available cash if you just drew down every, every dollar you had of availability? How much liquidity would you have in the system? How flexible would you be? And then from there, in this sort of fictitious situation, it shows everything's good. But then you can start actually, challenging some of the assumptions. What if my suppliers pass through a cost that I can't pass through to my customer? What if I have price pressures with some competitors and I shaved off just 7% of margin? Boom, I'm underwater on this scenario with just 7% of margin. I'm now looking at $700,000 is now missing out of my resources to actually be able to survive. I now got 10 months of liquidity in front of me. What do I do? So just one tweak of this model, and all of a sudden I start asking, very challenging, pointed questions to start getting into how do we actually cut it out. You see the bottom number shows if I don't raise capital, I got to take $95,000 a month out of a $750,000 OPEX number. That's pretty challenging, and I have to do that without actually incurring any costs and severance. So I don't know if I have that many non-people costs in that number. So anyways, I won't go into all the nuances of the model, but taking a model like this and really challenging yourself to look at the business in a bit of a different way, as Jerry Perkel said, well, what are the what if scenarios? You can use a model like this to really challenge some of those what if scenarios. Mark.
Great. Thank you, Randy. Thank you very much for sharing that. I hope you found that our audience found that useful and can apply some of that, and maybe you'll be available for help if anybody wants to run that scenario through you for their own business. You mentioned a point here, Randy. You said, in the example you used, what happens if your suppliers raise prices? How do I deal with that? You made a quick assumption. You said, and I can't. They raise and I can't, or you don't think you can, but then you showed you're underwater. What do you do if your supply raises prices? Keep in mind, your borrowing costs have already gone up as a result of interest rates going up. How do you deal with this?
Well, for me, there's really four steps. There's 4 steps to that question. First of all, am I getting a price increase? What's the reason for that price increase? It might be a trigger that my supplier is actually in trouble. Like they're just pushing a price increase through because they're financially in a tough spot. That's going to cause me to be concerned about, well, what if I'm single sourced on that supply or that product? So that's first alarm bell number 1, that I really need to get to the root of the reason for the price increase. The second is that I got to make sure that I've got the right alternative sources, and how can I shift volumes and make sure that I'm not vulnerable to a single source situation. And the second is that margin impact. Like, how can I actually engineer that out? Like, is there a way to work that supply requirement out of my system? Either I engineer it into my, or I find an alternative solution to have a workaround, so I don't actually need to have that element in my sale or in my product. And then as well, just I have to challenge my salespeople. Like, just no salesperson wants to pass cost along, but ultimately we're all the boats in the harbor are floating up at the moment. How do we then pass that through and challenge the sales and figure out the way to actually get that cost moved along, even though the first reaction is going to be, I can't do it.
Great. Thank you, Randy. Jerry?
Yeah, I think exactly building on what Randy said, to me, it's about value proposition. When things are going great and there's lots of demand, there's not as much stress on your value proposition as when things get tougher. So you really got to examine your value proposition to make sure you've got something that's going to make sense for your clients and for your clients as their businesses are evolving through this as well. You may choose to come up with a more entry level offering or something along those lines. To Randy's point, is this things that getting passed on to you getting passed on to your competition? Or do they have a different sourcing model so they're going to be at a different advantage than you are? And then I think the third thing is, in this time when there's this is going to impact your competitors disproportionately. Some of you are going to do well and some in the market aren't. That spells opportunity. It spells opportunity to capture some of their clients. It spells opportunity to capture some of their key talent, salespeople, maybe even acquisition if you're financially strong enough to do that. So make sure you think about this both from an offense and a defense standpoint.
Ramona?
Yeah, Mark, so first of all, don't wait for your customers to raise their price on you. Start thinking about what you could do now and start taking actions now. Start to review your cost structures and the options to reduce your costs, reformulate, secure alternate supplier agreements, parts, materials, whatever's critical in your supply chain. Attempt to firm up your supply agreements with changing terms, timing, warehousing. Think of all the costs throughout the supply chain and determine whether there are ways to renegotiate your deals with your suppliers that may cover more of those costs or offset some of those additional costs. You buy a lot of supply right now. We already talked about the risks of tying up capital, but you're also adding warehousing costs. that if you don't have it on site, that's going to add costs. You have to think about the whole supply chain. Oftentimes, if you look at reducing the cube of your shipping unit, in this case, maybe where it's corrugated, you're not just saving packaging costs, but you're saving shipping costs and storage costs because you're driving more efficiencies through the system. Look at alternating your purchasing cadence or your volume cadence. There's so many ways to dissect your cost structure, and don't be afraid to have these same conversations with your customers, offering them alternatives, especially if they're alternatives you can supply to them. I'll stop there because I know others have ideas. There are a million ways to think about this, but what I really would think about is break down everything in your cost structure to a lowest common denominator and think about how you can control each element of that cost chain.
Thanks, Ramona. Jaime.
Ramona, I love what you're saying. And just to add and specify, Walmart does this really well. So it's not only our point of view on how we can reduce costs, go back to the supplier. What's their point of view? What makes a difference? So for example, in Europe, I was dealing with MediaMarkt, and we shipped store to store. They want, and it was terrible. And we said the best thing for us is X, is to deliver 1 point. But only through having that conversation, we understood the levers of cost to them and the levers of cost to us. And asking the question, you miss 100% of the shots you don't make, but asking the question and understanding what matters to them and finding the common denominators. Very well said, Ramona.
Thank you. Kevin, and then Shep.
Yeah, I think one of the things, companies make money from their core competencies, and not enough companies have, vendor qualification, vendor selection as a core competency. So you need to have multiple vendors, so you have some competition, you have some options. That's something everybody can do right now, today. Secondly, I agree 100% with Jaime and Ramona in terms of talking to your customers. There's a lot of things you can do to take cost out of the system that maybe you haven't done in the past. For instance, maybe offering longer lead times. Longer lead times can let them have a lot of efficiencies in bundling their inbound supplies and a whole bunch of things. But question everything, find other ways that you can take the cost to serve down, and then you can enjoy those savings.
Thank you, Kevin. Shep.
And again, just to remember to maintain your flexibility and to pivot the discussions. My first answer to the supplier on a price increase is always no. And let's start with that. And then let's say, what are the things that I'm going to get in return for that? Whether that's lower mins, whether that's faster delivery. Because if I've established my parameters in that I need to conserve cash, I need to spend inventory faster, I need to reduce my overall inventory, then I understand the rules of the game. And just one tip that I learned through COVID, we contacted over 400 suppliers in our vendor network. And we said, we need different terms. We need to extend out payments. We need to bundle it up into a long-term note that moves our payments out 6 months or a year from now. With those 400 vendors that we contacted, we were successful with every one of them. Your suppliers will work with you if you are upfront with them, you ask for the terms, and if you're creative in what you're asking for. So be sure to ask.
Thanks. Let's change directions. People. So the people I have on my team, are they going to lead me through the recession? Would I enthusiastically rehire them over again today if I could? What have you learned about dealing with people going through a recession? Jaime.
I love the concept that your top people will be energized by that because it's a challenge. So identifying the top 20% people, understanding and redefining what success looks like to them in this new reality, and being transparent what it means to them in terms of what success looks like is tremendous. And it's been proven to me that we retain 100% of the top 20% people when we give them the freedom and the liberty to work on things that they can control, and they be rewarded by that.
Great, thank you. Jerry Perkel.
Yeah, I think it's a common understood thing when you're designing products that you stress test them to find out what's strong in the product and what's weak. This is your stress test. This is an opportunity to put a little pressure, a little stress on the organization, see who rises to the occasion and who runs away, which will help you to build a stronger team for the future. I think the last piece on this that I just would mention now is in the organization, if they don't have information, they're going to make up the answer. And it's almost always worse than reality. So in these times of challenge, communicate, communicate, communicate. Can't stress that enough to make sure everybody knows that we're in this together. We're working through the challenges and give an opportunity for them to raise up any questions or thoughts or ideas they have.
Thank you. Kevin?
Yeah, Jerry hit it right on the head. It is a stress test, and it's a good time to evaluate the strength of your team. But during a recession, a lot of good talent becomes available. So keep your eyes open. It's a great time to opportunistically add talent. And then, just the other add-on on communication. The number one thing I see people make a mistake at is they do the communication to people. They tell them, hey, here's what it means to the company. Here's what it means to your department. And then here's what it means to you. And that's just exactly opposite. You have to talk to people. What does this mean to you? What is that going to mean to the people around you? And then what does it mean to the company? So getting that communication direction the right way makes a meaningful difference.
Great. Thank you. Randy?
Yeah, just one quick point. Pew Research just did a recent study on the Great Resignation, and here's a recent study, and it broke down the reasons for the Great Resignation. I thought it was quite telling because the top 4 things were employees felt underappreciated, overworked without acknowledgement, personal needs were trampled, and they felt disrespected. And that impetus through COVID caused a huge outpouring of people changing jobs and wanting to leave their company. So, camaraderie wins in the middle of a storm like this. Camaraderie wins. So the fact is, we really got to focus on our people and just not assume that everything's okay, but actually get in there and create those bonds and pull your team closer.
Ramona?
Yeah, again, I want to reiterate, our employees' heads are going to be at home too, and worrying about how are they going to pay for their kids' school? How are they going to pay for gas today? So part of what we need to do is be in the confidence building and inspiration business. And that starts at the top. We also need to be in the deep appreciation business and let them know we believe in them, we count on them, we need them, they're important, but we understand that their families are important too. That empathy goes a really long way when stress is at its height for all of our employees. And then I think all these other comments about great talent being out there, taking care of and engaging our top 20%, they're part of the solution. Let them know. Jerry said it beautifully earlier. CEO doesn't have to have all the answers. They have to work with the team to get the answers.
Thank you, Ramona. Jaime?
No, Ramona, building on what you're saying is the mass customization. It's not what we communicate, it's what they hear. And creating those pipes, those channels, and don't assume that you know what each person needs. So understanding how to gather that information and give to people what it means to them and each one of them. So super important.
Thank you. Shep?
Just quickly, never waste a good crisis. So working this from the other end, make sure that you take the opportunity for those B and C players in the organization that you may have accumulated during this time where growth has been so significant. It's time to prune the bush. Take that opportunity and make your organization as efficient as possible and focus on your A players.
In a moment, I'm going to ask you each to give us one final big takeaway, to take away any advice you would give somebody leading a business going into what we know is going to be a recession. Before we do that, if any of you would like to talk to one of our coaches, we have a 20-point recession checklist. And if you want to walk through with one of our coaches at no cost to walk through your situation, Feel free to connect with us. You can do that through the chat that we have on the screen, and you can connect and walk through your own scenario with one of our coaches. If you want to walk through the liquidity test, you can do that too with Randy or one of our coaches as well. So feel free to reach out. We did this during COVID. We helped hundreds of CEOs around the world, and we're happy to help you here now too. We'll move now to final word. Ask each one of you on what advice would you give in 30 seconds to, as we close out here, to any CEO or leader leading a business today. Kevin Adams.
You need to have a recession playbook. And if you don't have one, you can't wait. You can't hope it's going to go away. And if you can't tell people what your playbook is, your playbook probably isn't good enough. So start working on it today.
Thank you, Kevin. Jaime, you want to go next?
Yeah, building, Kevin, I love what you said, but a lot of people are going to say we achieved those results despite the fact we took a lot of courageous decisions. And I'm going to say it's the opposite. We achieved the results exactly because we took all those courageous decisions, trimming the organization, fostering what success looks like for the top 20%, be courageous in pricing, so on and so forth, talk more with the customers, talk more with the vendors. So don't waste a crisis.
Thank you. Randy.
This is the time where the most value will be created or destroyed in the middle of this. If you think longer term down the road, how you get through this recession and how profitable you are, how much margin you create is going to be a strong testimony to how resilient your business is, and it will exponentially increase the value of your company, or vice versa. It'll show the business has vulnerabilities, and you'll be negotiating from a position of weakness.
Excellent. Thank you. Ramona?
Yeah, so any actions we take now will make us better when we come out. But the key is to communicate. Again, my three favorite audiences: employees, vendors, customers. I should probably add financial backers and investors. And it's not just communicate, it's listen, because that's where the gold is. Hearing what they need, hearing what you can do about it, and then acting on it.
Thank you, Ramona. Shep?
Leading in good times is easy. This is the time you earn your paycheck. Your job is to lead, be bold, lean in, act now, don't wait.
Thank you. And Jerry Perkel?
Yeah, I'd echo what Shep just said. This is the time for leaders to lead. Understand that everybody's trying to make meaning out of everything you do and say. Make sure that you're modeling the way. And what is leadership? To me, it's getting people to want to do that which needs to get done. So outline what needs to get done.
Thank you, Jerry. Thank you to our panel, Jaime, Kevin, Randy, Shep, Jerry, and Ramona. We appreciate you taking the time to share with us. And my final word is this recession is coming. You got to deal with it. It's your job as a leader or CEO or entrepreneur to deal with it. There are three kinds of people: those that make big happen despite it being a recession, those that let things happen, or those that ask, what happened? Have a great day. Thank you for joining us today.